everyone. Good afternoon and thank you for joining us today for this F1 Success Exam Specific Tips and Techniques webinar. I'm delighted to be joined today by Jordan Jenkins, who is a tutor from Astranti, to do this presentation for you today. Before I hand you over to Jordan, there are just a few housekeeping points I would like to make. To minimize disruption, you've all been automatically muted. If you would like to ask any questions throughout the presentation, please do send them, enter them into the questions box, as we will have a Q&A session after the presentation. And following this session today, you'll be receiving a copy of the recording of this webinar. So without further ado, I will hand you over to Jordan. Thank you, Jordan.
Thank you, Kim. Right, hi there. As introduced, my name is Jordan, and today I'll be going through some exam-style questions for F1 and show you how to approach them and give you some general tips and advice as I go. But before we begin, I would just like to tell you about a special offer we've got on for everyone at the webinar. You can gain free access to the F1 study text by using the discount code displayed on screen, which is F1 March 21, and you can use the discount code by going to astranti.com, or you can follow the link that I'll have posted in chat right now. If you follow that link, add the F1 study text to your basket, type in the code, and you'll have access to the study text. Make sure to use it by midnight on Sunday. Well, with all that said, let's actually start with the presentation. So, our first question. This is based on the F1A area of the F1 syllabus, which is on financial regulation. Now, what you see at the top here is a syllabus reference. You won't actually see this in the exam, but it's there so that you can see where this question comes from, what it's based on. And what we're told to do, or what we have to do, is understand the roles and structures of key bodies involved in the regulation of financial reporting. Now, my first really important exam tip for anyone that is doing these exams is to always go to the question requirement line, because there's going to be information in the scenario that may not be relevant to you, may not be relevant to answering the question. And so you're wasting your time by reading this first. Instead, you're always best to go straight to the question line. And here we're told, which body of the IFRS Foundation is responsible for performing the duties described above? And so then we've got these four options down here. We have to pick the right one. So it's always a good idea to know what these are and what they do. We'll start with the IFRS Foundation. Now, this part of the organization, they're like the board. They're responsible for appointing new members. So they appoint members. They are responsible for promoting IFRS. Okay, so they'll go around, they'll try and promote IFRS as a standard way of financial reporting. And they're responsible for the funding. So basically, if the question in the scenario mentions these factors, mentions these areas and says, which body is responsible for appointing members, promoting IFRS funding, it's going to be the foundation. Okay, none of the other bodies are responsible for these things. As for the International Accounting Standards Board, or the IASB, they're responsible for producing the IFRSs. So you can think of these as the manufacturers. So if you're given steps in the question, steps to how a IFRS is produced, the people responsible for that are going to be members of the IASB. Now, the last two, I often find these a bit confusing initially because they sound the same, but there is quite a big distinction between them. The IFRS Advisory Council you can think of as quality assurance. They're the ones that provide feedback on IFRSs that are in development. So during the creation of an IFRS by the IASB, they will often send one that's in the middle of production to the Advisory Council for feedback so that they can get some good information so they can update the IFRS and make sure that it works for everyone. So feedback. Whereas the IFRS Interpretations Committee, they're more like lawyers, you could describe them as. They're the ones that are able to provide some sort of interpretation of the IFRSs. So they provide advice or clarification. Okay, so essentially in the question, if you've got a scenario where a business is asking, can you clarify, please, this financial standard for us? It will be the responsibility of the interpretations committee to provide that clarification. And this is on standards that are in effect, right? Not ones that are in the middle of production. So those are our four. Now that we know what the four are, we can read the scenario and attempt to answer it. And in the first sentence, we're told an entity has submitted an inquiry concerning IFRS business combinations on the use of the equity method of accounting. Well, straight away, that first sentence would make you flag up and think, well, that sounds like something the Interpretations Council would do, or Interpretations Committee, sorry. But if we read on, because it's always good to read the rest of the question, but we strongly suspect now it will be D. The entity submitted this to the relevant international financial standards body. That's our way of trying to hide, of course, which one is correct. This body disclosed that sufficient guidance is already provided within IFRS 3 business combinations concerning the use of the equity method and stated that these issues would not be reviewed any further. That is something the Interpretations Committee would actually do as well. This is based on an actual report from the Interpretations Committee. So basically, the Interpretations Committee are responsible for handling inquiries. It's clear that that's what this entity is doing. So it's not involved with funding. It's not involved with production. We're not looking at feedback. It's about getting clarification. So it's the Interpretations Committee. This is a remarkably easy question and one that you might get in the exam, and it can be worth, a fair amount of marks if you can just get it right, get it done very quickly. So trying to get these easy questions done, understanding IFRS, the way the organization is structured, can be some easy marks in the exam. So don't forget to revise that. So that's question 1 on F1A. For question 2, we're going to move on to F1B, which is on the preparation of financial statements. So again, syllabus reference. Basically, what we have to do is apply recognition, initial measurement, and subsequent measurement principles in the financial statements of the lessee. So in F1, you will have to know IFRS 16, which is on leases, and you'll have to know it from the perspective of the lessee. And this is essentially the person who purchases a lease contract from a lessor, and this gives the lessee the right to control an asset for a specific period of time. So as for the question requirement, again, same rule as before, go straight to the bottom line. Which 3 of the following are correct? All numbers are expressed to the nearest pound. That's important for when you do your math calculations. And you can see we've got 6 options, but they're basically 2 of them are the same as each other. We've just got to figure out which one is correct. So you've got something called the right of use asset at cost, annual depreciation, presumably of the right of use asset, and the carrying value of the right of use asset at the end of year 1. So we're only applying 1 year's worth of depreciation. So to start with, what is the right of use asset? Well, it's essentially the asset the lessee has control over, so like a car or an office for a given lease period. But for the purposes of this question, we need to know how to work it out mathematically. And essentially, the right of use asset is equal to the lease liability plus any direct costs. Now, the lease liability is formally, it represents the present value of future lease payments discounted using the implied interest rate. In simpler terms, it's essentially what the lessee owes the lessor for the right to own the leased asset. It's obviously a little bit more complicated than that, but there you go. And as a point of order, you'll not be, let me bring that back up. My apologies. So essentially, the lease liability, you will not be asked to calculate it in the exam. You'll always be given it in the question. As for the direct costs, well, what I've got here is an image from the F1 study text itself that we can use as a point of reference. So these here are all components involved in the right of use asset. And you can see here we've got the lease liability. Then we have what are called initial direct costs. So this is to do with things like taking the asset to its location, installing it. Those are initial direct costs. cost of dismantling, so removing the asset from the location, that's also added. And then a more complicated one, early payments less incentives. Essentially, if the lessee pays something early and the lessor also pays the lessee some sort of incentive to perhaps make that early payment, then the difference between those two figures is also a direct cost. So all of these are involved in calculating the right of use asset, but we may not need all of them in the actual question. So let's have a look at the scenario, and we'll get onto depreciation when we see it in the scenario as well, just in case you think I forgot about it. So entity XYZ enters into a 5-year lease for the use of 3,000 kilometers of fiber optic cable. With lease questions, always make a note of the lease period, as that is important for the depreciation. Lease payments are £14 million per year, paid in arrears at 2.4% interest. Nothing much of use there. This is going to be used for calculating the lease liability, but we don't need to do it because the lease liability is initially measured at £62,172,489. So we've been given the lease liability. Then we're told that XYZ incurred additional direct costs of £230,000 and dismantling costs of £1,500,000. So we've got two direct costs plus our lease liability. And then the last sentence tells us that the useful economic life of the asset is estimated to be 10 years, and we're using straight line depreciation. So we only have two direct costs to worry about, which is the initial and the cost of dismantling. So how do we work out the right of use asset? Well, we just take the lease liability, which is £62,172,489. We then add the initial cost, which is £230,000, and we add the dismantling cost, which is £1,500,000. Add these all up, and your answer should come to £63,902,489. Well, if we look at our answers then, obviously it's option B. That's the one that matches. So we can cross off A, and now we've got our right of use asset value. Great. Now on to depreciation. So this is why I told you to make a note of the lease period, because when it comes to depreciation of leases, it is calculated by dividing the value or the cost of the right of use asset divided by the lower of the useful life or the lease period. And you might be wondering why the lower of the two. Well, if you think about it, it wouldn't be faithfully representative if you use the 10 years, because you're not going to be using the asset, for 10 years. You're only using it for 5 years, and using 10 years will decrease the depreciation by too much. It'll artificially decrease it. So you want to use the lower of the two, and the lower of the two in this question is going to be the 5-year lease period. So our depreciation is going to be equal to £63,902,489. Divide that by 5, and so our depreciation will come to £12,780,497.8. Remember, we're told that we should calculate to the nearest pound, so we round this up to 498. And if we look at our options, well, it's going to be C, isn't it? C is the only one that matches, so that's our final answer. Then, if I just make that a bit smaller for us, our final two options, the carrying value. Well, now you can actually use the question to help you answer the question, essentially, because you don't need to look at your notes now. You can just take away the two values that you know are correct. So we know the right of use asset is B, the annual depreciation is C. So the carrying value is the difference between B and C. So £63,902,489 minus £12,780,498 will give us a carrying value of £51,121,991. which is going to be option E. Obviously, that took more than a minute 30, which is what you'd have in the exam. But when you know how to calculate the right of use asset, you'll be doing most of this on your calculator, and this could feasibly take you probably maybe about a minute or less than to do once you know exactly what it is you need to do. So that is question 2. What about question 3 then? We're going to be sticking to F1B for the moment. And in this one, we're looking at IAS2 inventory. So we have to identify the components of the cost of inventory and how it should be measured at the period end. Same rules as before. Question requirement line. In accordance with IAS2, what would be the value of inventory shown in Alepha's statement of financial position? So with inventory questions, much like the lease period or with the depreciation in the lease question, there's a specific rule you have to be careful of. So when measuring inventory, you have to measure inventory under IAS2 at the lower of cost or what's called net realizable value. Okay, a net realizable value is the selling price of the inventory. So the selling price minus the cost of selling. So when you're measuring inventory, you'll work out these two, and whichever one is lower is the one that will be presented in the financial statements. So let's begin then. We're told that at the end of the financial year, 25% of Alepha's inventory that originally cost 1,590,000. So we've got our cost value here straight away, but 25% of that inventory, as we found out now, is damaged in a warehouse fire. So the cost is going to be a bit lower. The goods that were undamaged by the fire can be sold for 1,404,000. So that's our selling price for the undamaged goods. So make a note of that there. And then the damaged goods themselves, they can be sold for £280,800. We're then told which is 40% reduction on the original price. That doesn't really tell us much at the moment. The last bit though does, because we still haven't worked out what the cost of selling is. And we're told that the cost of selling the goods to Alepha's clients is 5% of the sales value. So while we haven't been given the physical value, we can work it out using this 5%. Now, with these questions, it's always a good idea to split the page and work them out side by side. So what we're going to do is calculate the cost and NRV side by side, starting with the damaged inventory. Split that down and across. So starting with cost, as it's the simplest. Well, it originally cost £1,590,000, but 25% of it was damaged. So all we have to do is multiply it by 25, and the new cost, and the cost of the damaged inventory then will be £397,500. So that's our first bit. Now, what about the net realizable value? Well, we know from the question that the damaged goods are sold for £280,800, but we still don't know the cost of selling, but we can work it out by multiplying this figure by 5%, as that will give us the cost of selling. So multiply by 5%, and the answer is £14,040. Now that we have the selling price and the cost of selling, we can find the difference between these two. So 280,800 minus 14,040, and our figure should come to £266,760, if I can just squeeze it in. There we go. Right, so our first thing, we need to compare now the damaged inventory against cost and net realizable value. Which of the two is the lower? Well, it's going to be the net realizable value. That's the lower of the two. So part of our inventory measurement is going to be using this figure here. So that's our that's our damaged goods. What about the undamaged then? So undamaged. Well, Same thing as before with cost. We can do the original value, so 1,590,000, but it's not the 25% that was damaged. We're now doing the reverse. So we're now multiplying this by 75%. And 75% of 1,590,000 is £1,192,500. All right, simple enough. The NRV is where it's a little bit more complicated, but same thing as before. We're told that the undamaged goods can be sold for 1,404,000. So 1,404,000 multiplied by our 5% to find the cost of selling, which brings us to £70,200. Now find the difference, 1,404,000 minus 70,200. And our figure is £1,333,800. Okay, which of the two is lower, cost or NRV? Well, it's clearly the cost. So the cost is going to be used when we're measuring our inventory, the total value of the inventory. And if we look at it, okay, so what we have to do now is add the two together. So our inventory is going to be equal to 1,192,500 plus 266,760. So our final answer should be 1,459,260 pounds. Okay. So again, the major problem is this up here. You need to know the lower of the two here. Once you know that, the rest of it is reading comprehension. You just need to identify which figures need to be used and just plug them in a very formulaic order as we see here. Okay, so inventory can be quite simple. It's just the cost and net realizable value you need to nail. For question 4, we're moving on now to tax. So this is F1C, Principles of Taxation. And in this one, the syllabus reference is calculate the capital tax on the sale of an asset. And if we look at our question requirement line, we can see what is the capital gains tax liability on entity EP's disposal in 20X8. Okay, so first thing, capital gains, what are they? Well, essentially capital gains are the profit that you make, profit made on the sale of a non-current asset or investment. The tax liability then is the tax that is levied against this profit. Now, when it comes to tax computation questions that involve capital gains, there is a pro forma we can use. And this pro forma will apply to the majority of these kinds of questions. As you can see, all we have to do is find the sales proceeds, the original cost of the asset, selling costs, indexation allowance, and chargeable gain. Now, some of these might change depending on the content of the question, but generally speaking, this is the pro forma you want to use. This is something you should try to get used to and try to remember, because it's easier to work out an answer using this than trying to do it and improvise the answer as you go. So let's look at the question itself. We're told that entity EP is a resident of country X, and all costs related to the purchase and sale of the asset are tax deductible in country X. What does that mean? Essentially means that, well, the cost of selling the asset doesn't need to be included in tax. It can be removed. It is tax deductible, which is why in this pro forma, which is why I said it's important you read the question and you recognize what needs to be included. It's why we remove the cost of selling the asset, because when we get to the capital gains tax, we shouldn't be including the cost of selling in that tax calculation because it's tax deductible. Now, as for the machine, we're told that in 20X4, EP purchased a machine for £50,000 and the setup costs were £10,000. Right, now we have to be careful because this is a bit of a sneaky question. It's using a bit of F1B and it's assessing whether you understand and know IAS 16 property, plant and equipment? Because in IAS 16 property, plant and equipment, it specifies how you're supposed to initially measure an asset. And we need to find the original cost of this non-current asset. And IAS 16 specifies that when initially measuring an asset, you take the purchase cost of the asset plus any direct costs, which include setup costs. You do not include any unnecessary costs in the initial measurement. And the example that is given is a thing like maintenance service. It's optional. It's not needed to get the asset into working order. So as we see here in this paragraph, as part of the purchase, the seller offered a maintenance service for the machine for the next 3 years at an additional £5,000, which EP accepted. If you didn't know IAS 16, you might think that you have to add these three together to find the original cost, but that is wrong. Because of IAS 16, you should actually ignore the maintenance service and just add the two together, because that is what the original cost of the asset will be. So 50,000 plus 10,000 is of course £60,000, and that's our original cost. In the next paragraph, we're then told that the cost of the machine was depreciated at 20% on a straight line basis. In 20x8, EP sold the asset for £80,000. So those are our sales proceeds, £80,000. Then we're told that £1,000 worth of selling costs were also incurred as part of the transaction. So £1,000 here. And then we're given some more information about the depreciation policy of the business. Because we're dealing with chargeable gains, depreciation is ignored. We don't consider the depreciation because we're talking about, again, the original cost. So much rides on getting this figure right. The original cost is what matters. And if we're talking about the original cost, we're not bothered about depreciation. So we can ignore the depreciation bits. Then as for the final paragraph, between 20x1 and 20x9, the indexation allowance set by country X is 30%. The indexation allowance is essentially there to account for inflation, because remember, this asset was purchased in 20x4, wasn't it? But it was sold in 20x8. So 4 years have passed since its purchase. Some inflation will have occurred in that time. So we need to remove it and take account of it. So how do we work it out? Well, we take the original cost of the asset because that's what it was purchased at. Original cost, £60,000, multiplied by 30%. And that will give us a figure of £18,000. So £18,000. So we take that away up here. Right, and our pro forma is now pretty much complete. Add all of these figures together and the chargeable gain, so the profit that EP makes on the sale of this asset is £1,000. But we now need to work out the tax, because remember the question asked us, calculate the capital gains tax liability. Important that you carefully read that question, because sometimes you'll be asked for only the chargeable gain. So if you work out the capital gains tax and then put that as your question, you'll be wrong. And the same is true in the other direction. If you're asked to calculate the capital gains tax, do not forget to actually calculate it. So we're told in the question that the corporation tax rate is 20%. So we just multiply 1,000 by 20%. And so our tax liability is £200. Okay, so capital gains tax looks complicated on the surface like so many of these questions, but once you've got a pro forma set, it's easy enough. Then for our last question, which is on the calculation of receivable days and comparing them. So this is an F1D question. This is on calculating cash and working capital. So same rules as usual, we go to the question requirement line. We're told that what is the difference between Zuzu's receivable days before and after the change in credit policy? So first things first, receivables. Receivables, what are receivables? Well, receivables are the amounts owed to a business. So amounts owed to a business. Okay, in this case, Zuzu. So it's the amounts owed by Zuzu's customers to Zuzu. The receivable days is an estimation of how long it takes Zuzu to collect. So the time it takes to collect receivables, time it takes to collect. And what's happened is that Zuzu has decided to change its credit policy, meaning the length of time it is given its customers to pay in cash is changing. So instead of maybe providing 60 days before customers have to pay, customers now have to pay in 30 days. And we are being asked to find the difference between one credit policy and the next to see the change in the receivable days. So how do we actually calculate the receivable days in that case? Well, what we do is we use a ratio called the receivable days ratio, and it equals the company's receivables for a given period. We divide that by the company's revenue during that period, and then multiply it by 365 days. Because we're working in financial years, we're working in financial periods, so we multiply it by a whole year. So that is the key ratio we need. Now, if we look at our question, we're told in 20x1, company Zuzu had a gross profit markup on sales of 33%. The cost of goods sold, or cost of goods, amounted to £26,250,000. And then we're given some extracts from Zuzu's financial statements: inventory, trade receivables, and trade payables. Which one do you think would be relevant to us? Well, it's going to be the receivables, isn't it? The other two, inventory and trade payables, have no part to play when it comes to calculating the receivable days. So we have our receivables, but we don't have our revenue yet. So let's just read on and just make sure we haven't missed anything. To reduce the amount of time it takes customers to pay, Zuzu is going to reduce the credit period it offers customers. Now, as a consequence of this, it is expecting revenue to decrease by 10% in the next financial period and trade receivables to decrease by 35%. So the reason a company might reduce its credit period is A, to make customers pay earlier, is what Zuzu wants here. But as a consequence of doing that, customers may not like the new credit policy, so they may not do business with Zuzu again. And so that's why you might see a decrease in revenue, but why you will also see, well, expect to see a comparable decrease in trade receivables as well. But as you can see, we still got nothing on the revenue. So what do? Well, if we go back to the top, we can see that we're kind of being given a clue as to what the revenue is going to be, but we have to work backwards from somewhere. We have to work backwards from the gross profit markup formula. Now, as a point of order, CIMA will not assess, or the CIMA exam isn't meant to assess your mathematical ability. But there are cases, and I've certainly been on the receiving end of a few in my exams, where you will be asked to rearrange formulas, okay? It will try to test whether you know how to do it, whether you know how to work backwards from a problem. So, gross profit markup. The gross profit markup percentage is equal to the gross profit divided by the cost of goods sold. Well, we've got the 33%, we've got the cost of goods sold, but we don't have the gross profit itself. So this is where we need to rearrange our formula. We need to take the cost of goods sold to the other side of the equal sign. If we do that, we multiply our 26,250,000 by our 33%. And that will give us £8,662,500. That's our gross profit. But we still haven't got revenue. Well, what's revenue? Oh, sorry, what's gross profit rather? Well, it's revenue minus cost of goods sold. So to find revenue, you just add the cost of goods sold to the gross profit. So revenue is equal to 26,250,000 plus our 8,662,500. And so our revenue will now be £34,912,500. So we have all the information we need now. We can finally work out our receivable days for 20x1. So receivable days x1 is equal to our receivables, which we know are 9 million, divided by our revenue, which is 34,912,500. And don't forget the multiplication of 365. Common mistake, something that is easily forgettable. Don't forget about it, as it will mess up your answer. So if we do all that, we'll find the answer to be 94 days. You'll see a decimal point if you do it in your calculator, but remember, we've got to do it to the nearest whole day. So it doesn't make sense to have it as a decimal anyway, so we round it up to 94 days. What about the next financial period though? We're told that revenue decreases and trade receivables decrease. So how do we work it out? Well, we've got to calculate the new revenue figures. If revenue decreases by 10%, that means that the new revenue figure will be 90% of the original. So we take our 34,912,500 and multiply it by 90%. And so our revenue for the X2 financial period will be £31,412,250. Receivables gets the same treatment. If our receivables are 9 million originally and they decrease by 35%, then the new figure will be 65% of the original, just the difference between 100 and 35. And that will come to £5,850,000. Now we can work out the receivable days for the X2 financial period. So we just take our receivables and our revenue again. So divide 5,850,000 by 31,412,250. Don't forget to multiply it by 365, and your final answer will be 68 days, or 67.9 in the calculator, but remember we rounded up to 68 days. Not done yet. We now need to find the difference between the two. So the change in the receivable days period, well, that will be 94 minus 68, which is equal to 26 days. And that is your answer. So it's quite an involved question, admittedly, but I'll say now that I've seen this kind of question come up before in exams. I've seen it come up in various forms. Again, with rearranging the formulas, that's something that can come up. And also, I remember in my F1 exam, there was a question which had something similar where credit policy was changed. And so I had to work out the new revenue and receivables based on the change in the credit policy. So that brings me to the end of the questions I have here. And before we get on to Q&A questions, I wanted to go through some useful exam tips that I think will be invaluable when it comes to the exam, as they're things that I actually did myself. So to start with, use the flagging system. In the Pearson VUE tests, you will have the option to flag questions throughout the exam. Why would you do this? You have 60 questions to answer in 90 minutes. That's 1 minute 30 per question. If you look at a question and within 30 seconds, you can't see a way of figuring out, or if you do, but you know it's complicated and you don't know how long it might take you, flag it. Click the flag button, move on. The CIMA exam is very much a numbers game at the end of the day. You need to answer as many questions correctly as you can, because trying to answer that one really difficult question for 5 minutes means that you could have potentially answered 10 easier questions that would have been worth more at the end of the day. The reason why you should flag it rather than answer it, or if you do answer it but you're not sure and still flag it, is because if you get through the exam quickly enough, you will have time at the end to go back to these flagged questions, which is what you'll see on screen here. So you'll be asked to review your questions. You can see the questions that you flagged, go back to them and answer them. In my F1 exam, I had 20 minutes before it finished to go through the questions that I had flagged. And that was so beneficial to me because some of them were really nasty questions. I needed more than 1:30 to work through them. And so that 20 minutes really gave me an edge when I did it. So use flags. 2, make notes at the beginning. Now, I did my exam before the pandemic, so I was still in the test center. So I'm not entirely sure how the note system works online at the moment, but presumably I know you can still make notes in the digital exam environment. So what you can do is spend a minute, no more than that, I would recommend, writing down formulae and ratios and definitions in the notes in the CIMA exam. That way, then, when you come to questions which might require you to recall things like the economic order quantity, the various working capital ratios, definitions, maybe if you need to remember certain things like, like the IFRS organization. If you've forgotten or you're having trouble remembering the difference between advisory and interpretations, make a quick note of it. Advisory is QA, interpretations is lawyers. Easy note, saves you time in the exam trying to remember it. Then the last one, use the storage function on your scientific calculator. This is something I've wanted to tell students about for a while, but it's quite difficult to explain over a message, and it's much easier to demonstrate for you. So what you see on screen right now is an emulation of a Casio calculator, one that should be CIMA approved in the exam. Now, the benefit of using a scientific calculator is that you can actually store the answers you calculate in the exam to the calculator's memory. This makes it faster to recall it. It makes it easier to write down the figures and make sure you don't get it wrong. And obviously, if you write down any calculations wrong during your workings, it can have a knock-on effect on the answers. So what do? Well, what you can do is, let's say I have a really horrible number. Let's just have a nasty square root. Square root of 125. Right, let's say I had to write that down. It's going to take me time to go through and note that down. It's going to take me precious time in the exam. So what you can do is click the STO button on your scientific calculator. The placement will be different based on brand, but generally there'll be an STO button. Click that, and now you're in the storage function. What you then do is assign this number to a particular letter. If you click this one, for example, you've now assigned the square root of 125 to the letter A. So if you wanted to call it back up, click alpha. So that means that all the buttons with a red letter to it will now result in that rather than the default button. So alpha A, if I click equals, there we go. It's the square root of 125. Now, why would I use this in the exam? Well, let's say I've got two nasty calculations, like say, I don't know, the square root of 85 as well. Well, I can do the same for this one. Rather than write it down, store, place it in answer B so it doesn't overwrite A. Then I can add them together. Alpha A plus alpha B, and I get my result. This is far faster in the exam. It's much less prone to error because you're not physically writing it down and having to look back and forth on your calculator. And it means it's easier to do some of the more complicated questions in F1, like calculating the economic order quantity, cost of discounting, which has a power in it, which can result in really nasty numbers. So yeah, practice with the storage function on your calculator if you have it. It's invaluable in the exam. I used it all the time. And yeah, it's often underused in my experience. Not many people actually know about it. So yeah, that's the end of my my presentation. Are there any questions, Kim, that have come up in chat that would like to be answered?
Thanks, Jordan. No, there's no questions that have come through as yet, but if you can please put them in the questions. I'll just do a quick poll for everyone while we wait for questions. So I'm just going to put the prompt up on the screen. Hope everyone can see that now. I've just, the first question we have are there any F1 topics you would like to cover next time? So if you can start filling in the poll question now, that would be great. And I'll just check for, We have had some questions in regards to the recording of this session, so we will be sending a copy of the recording of this afterwards, so you should be getting that at the end of the day today.
If I can just say then as well, as a reminder, if you enjoyed that session and you'd like to understand more about the F1 topic, and obviously carry on with Astranti, then we're offering the F1 study text for free on the website. So I'll just put it up on screen again for you.
Let me just.
Oh, that's okay. So the redeem code is F1 March 21, and the link to the website is in chat right now. Follow that link, type in the redeem code at the purchase point, and you'll get your free F1 study text.
Okay, great. All right, so I've got a question here. I'm currently studying E1. Will there be a webinar for E1? Yes, Joanna, there will be one coming shortly. So please look out for that. We should receive an email. Okay. Okay, still no questions that have come through, so I'll just then just lead with the final poll question, which I launched, and you can see on your screen now, and it says, did you find this presentation helpful for your F1 exam, and do you feel more comfortable or confident in going to sit your exam? So if you can fill in that poll question now, that will be really helpful to us. Okay, great. All right, so just going to close the poll question now, and I'll share the results on the screen. And for the majority, 93% say yes, which is absolutely fantastic. So that's really good news to hear.
Thank you.
Great. Wonderful. So I just want to leave that there then if we've got no other questions. But I just appreciate you, Jordan, in doing this presentation for us and giving up your time to help. I also do appreciate everyone giving up their lunchtime to come to attend this session. So thank you so much for attending. Like I said earlier on, we will be sending a copy of this recording to your email address at the end of the day. So please look out for that. But that's all we got time, so I'll leave it there. Thanks very much everyone for attending, and enjoy the rest of your afternoon. Thanks everyone.
Thank you everyone. Bye.
Bye.